And now, in studio, bringing his Midwest values from the Show Me State to the land of San Diego. He's a triple threat, licensed as an attorney, mortgage broker, and a top producing realtor who's crushing the competition. Here to deliver you what's happening in the trenches of the market. Your host, Michael Gaddis.
Welcome back to the Michael Gaddis Show on AM 1170 The Answer. I am your host, Michael Gaddis of FrontierLoanGroup.com. I have a very special guest joining us in studio today. I have Will Afzali, also of FrontierLoanGroup.com. Thank you for joining me today, Will.
Thanks for having me here.
We're going to talk a little bit today about reverse mortgages and a recent change to it, which is the financial assessment requirement of reverse mortgages. Now, Will, I'm going to tell you, I recently got into a little exchange with somebody on Facebook about reverse mortgages. And of course, it comes down to that age-old, misconceptions and myths that they have about them. And after going back and forth with this person online, and it took a while, but eventually, the person softened to the reverse mortgage. And I said, look, it might not be right for you, but you cannot look me in the eye and tell me that it's a horrible, horrific product. It is not. And I think that a lot of that comes down to education and knowledge, and not just listening to what you hear on the radio from people other than me or read in the newspapers. This product, reverse mortgage, can literally be life-changing. They can literally alter a way a human being lives. And I have seen it time and time again. And so what I want to talk a little bit about today is some of the protections, at least one of the protections that FHA put into the reverse mortgage program, the HECM program, to kind of make the product an even better product. And that is the financial assessment, which has to do with being able to basically afford the loan. And the financial assessment is different than the requirements in a forward mortgage. So, Will, can you tell us a little bit about the difference between the financial requirements of a reverse mortgage versus the financial requirements in a forward mortgage?
Sure. So in a reverse mortgage, they're going to look at the first thing is your property charge history. So they want to make sure that the borrower is able to is maintaining their payments, on all their property charges, HOA. Taxes and their current payment. So before you could be behind on your payment and be headed towards a foreclosure and do a reverse mortgage. But those people weren't able to afford their property payment, and that's why you hear all the horror stories about people getting foreclosed on.
Well, I think, and just to define, I guess I'll answer the question a little bit more thoroughly. Basically, in a forward mortgage, you have to meet certain debt-to-income ratio requirements. You have to have certain ratios, 43%, as a standard debt-to-income ratio. And what that does is it takes, and I'm talking broker talk right now. It takes basically your gross income and analyzes it versus your revolving expenses, your mortgage, your principal, interest, taxes, and insurance, your revolving debt. All of that's put into a ratio. But in the financial assessment requirement of or analysis of a reverse mortgage, they're looking at if you have disposable income at the end of the month. Is that correct? Exactly. Residual income. Mm-hmm. So they want to make sure that you have enough money at the end of the month to basically live on after you pay your bills. That's really what they're looking at.
That's exactly it.
It's not a huge requirement. It's not daunting in any way. It doesn't have the pitfalls of a forward mortgage. Mm-hmm. And as Will was pointing out, there are basically three components to these. And the first is the property charge payment history. Mm-hmm. And basically, as Will was saying, basically what it does is they're making sure you haven't defaulted on any of your things that you need to take care of for the property, right?
Correct.
And those things are what? Like
taxes, HOA, your current mortgage payment, your principal and interest.
Yeah, they want to make sure that you have a clean record of paying your bills, because they, as Will mentioned, they don't want to get into a situation where as you've heard, oh well, this person lost their house because of they didn't pay their property taxes. They want to make sure that you can pay your property taxes, and they require this financial assessment to be able to do it. Now the second component of it, there's three components to the financial analysis. There's the property charge payment history, the credit history, and the residual income. So we've talked a little bit about the property charge payment history. Will, tell us a little bit about what they're looking at the credit history.
So in the credit history, they're just trying to make sure that the borrower is able to demonstrate responsible management of debt. So this is going to come down to just the borrower's willingness. Is he responsible? So they're going to look at if you can help me out here, I'm freezing.
Oh, they're going to look. It's all right, Will. It's all right. They're going to be looking at things like collection accounts, charge-off accounts, judgments, delinquent federal taxes and non-tax debt. They're going to look at delinquent FHA-insured mortgages, because this is an FHA-insured mortgage, and they're going to look at disputed credit, and they're going to look at see if there's a bankruptcy. But and just for the record, though, a bankruptcy does not disqualify a mortgager for consideration. So just because you had a bankruptcy, it doesn't disqualify you. But they're going to look at it and they're going to analyze it. And they're going to require that certain time periods have elapsed. So it's 2 years from a Chapter 7 and 1 year from a Chapter 13. So they're going to make sure that you have some pretty clean credit, but it's not like it has to be squeaky clean. They're going to look at the presence of significant derogatory credit. They're going to look to determine the cause of it. What caused the derogatory credit? They're going to verify how long it's elapsed since then. So basically what they're doing is just kind of looking through your credit, and it's different than a forward loan because it's more analytical, it's more formulated, it's more subjective in a reverse mortgage. They're just kind of looking at it with a common sense approach.
Yeah, they're not looking at FICO score. So FICO score is not a determining factor here.
In fact, they even have extenuating circumstances for issues that might be above and beyond your control on those. Isn't that correct?
Exactly. So if you fail to meet the standard history requirement, then like you said, they're going to look at what is going on. Is there an extenuating reason? Is it a one-time reason? I mean, what is the overall picture, and what's going on with that borrower?
Well, you're listening to the Michael Gaddis Show on AM 1170 The Answer. I am your host, Michael Gaddis of FrontierLoanGroup.com. I am joined today by Will Afzali, who froze up a little bit a minute ago, also of Frontier Loan. It's all right, Will. We forgive you. So just hitting a little bit on that extenuating circumstances. Someone might be saying, well, that's a fancy word for what? Well, it's a fancy word for things like loss of income due to death or divorce of a spouse. That directly relate to your late payments. So if you are in the middle of a divorce and all of a sudden you had some late payments, well, you can explain those. So extenuating circumstances is a kind of a method for you to explain away some of the issues that you might have had. And so loss of income due to mortgagors or spouses' unemployment, increased financial obligations due to emergency medical treatments, emergency property repairs. So in other words, it's a very subjective analysis. It is not something to shy away from. It is a very, very subjective way to look at it. They're looking at what happened to you and why, and what were the after effects of that. And that's what's another really good thing of that.
Yeah, and like in a forward loan, like you said, you can get your loan approved by an automated machine. But all reverse mortgages are analyzed by a DE underwriter. They're all manually looked at.
Well, the other thing that the third test of the financial assessment analysis is the residual income, and that's called the cash flow analysis. And basically what they're looking for is to make sure that you have the willingness and capacity to pay. And so what they're going to do is they're going to look through your income, and they're going to see what your income is. And they're going to look at different types of income, W-2, 1099. They're going to do VOEs, 4506Ts. There's a lot of different income. It's not nearly as daunting as a forward mortgage, but they are going to ask for some income requirements. I mean, some documentation here, so that they can determine exactly what you're making, determine if you have the willingness and capacity to pay for it. And I think that as far as the paperwork is concerned, it's not necessarily that. I mean, it's not as bad as it seems, is it, Will?
No, it's not. It's not that bad at all.
And thank you for that answer.
very, very detailed.
The other thing I want to mention is that what they're ultimately determining is that you have a residual income after paying your bills of a certain amount. And I'll give you an example. in California falls in the West. And for a family size of 1 in the West, the requirement is that you have $589 left after you pay your bills. That's not a very daunting figure. You can easily obtain that. If there are 2 individuals, it's $998. So if you're husband and wife and you want a reverse mortgage, after we look at your income and take a look at all your credit, you have to have $998 left at the end of every month in order to satisfy that requirement. But I think that there's also compensating factors in that. So let's say you don't have the ability to do that. Let's say that you don't have, let's say you come up and you're only $600. You're a married couple and you have $600. Well, here's the thing. They have compensating factors. Just like there was extenuating circumstances on your credit, there's compensating factors in your income. And some of those are like debt obligations that will be eliminated as a result. So in other words, if things are being paid off and you'll have more cash flow. For example, if your mortgage is being paid off, you're going to have a lot more free money and it's going to affect your residual income. So an increase in monthly income through term and tenure payments. In other words, if you get, that's a different type of way you can get paid on a reverse mortgage. So if you're getting a term payment or tenure payment, they can add that to there. So there's a lot of different ways, Will, that you can get through with a compensating factor, even if you don't meet the residual income requirement.
Yeah, you can also do assets can be dissipated as well.
That's right. You can take assets and you can kind of go through and talk to them a little bit. I mean, you could take it. Sorry, Paul was pointing 2 fingers up at me and got me off track there. I was really on a roll there. Thanks a lot, Paul. I know. So anyway, back to what I was saying. Basically, there's a lot of compensating factors that can come in and basically make up for the lack of residual income. So, well, we're going to go on break, and when we come back, we're going to continue our conversation with Will Afzali of the Frontier Loan Group. You're listening to the Michael Gaddis Show on AM 1170, The Answer.